Hey, what's up, everybody? It's Jeff White, Jeff White Fitness Solutions. Thanks for checking out this video today. And today we're going to talk about some financial fitness or some financial situations that's going on around the United States and the world, actually. And that right now, as you can clearly see, is the banking situation. Now, we've all seen and heard about banks closing and bank branches closing and the banking collapse of different banks over the last year, and a lot of people are really confused about what's going on and what's going to happen next. Well, I just want to remind everyone that this is all pre-planned. And last November there was a meeting held by the FDIC where they talked about exactly what's going on today. And unfortunately, a lot of us have short term memories, but I think it's important we revisit that meeting that they had so we can see exactly what they saw back then and where we are now. So please take a look at this video. This is very, very important. And leave me a comment and let me know what you think, because this is something that's not discussed in mainstream media, but they talked about this last November 22. So this is a year ago. They talked about exactly what's going on today. Okay, so let's run these clips.
I'm also wondering if we need to be more transparent about some of the accountability mechanisms that we have as well for the general public audience. We are required to remove culpable management. How would we go about doing that? Do we need to re-emphasize that in the Dodd-Frank hierarchy that compensation claims are subordinated to general creditors, and that prior compensation could even be clawed back if needed? And then finally, there's the funding mechanism. What part of that would be most helpful to boost confidence? I do think that the OLF and using it as the big gift, it's not a gift, but the big tool that we need in Title II to help provide confidence. But what do people need to know to really get that? How important is it to explain the rules and the mechanics for the OLF? How money will get from point A to point B. How would we use targeted guarantees to allay concerns about excess cash use? There's a lot of questions here. And so, there are a lot of things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II, so that if and when we do have to have that announcement on Friday night, ideally Friday night, that people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on. So with that.
Okay, so I want to stress again that this meeting was back in November 9th, 2022. And this video that I'm making is being recorded on December, what's today's date? December 9th, 2023. So this video was made a year ago, and I'm making mine a year later. Hindsight is a wonderful thing. You can always look back and see what was going on, and you can say, oh, I may not have understood back then, but now I do. So she was talking about Title II. So my first question is, what the hell is Title II? Because I honestly didn't know. So of course I just looked it up. And let's read some of it together. Title II is a provision of the Dodd-Frank Act that provides a process to quickly and efficiently liquidate a large, complex financial company that is close to failing. Okay. Title II is a provision of the Dodd-Frank Act that provides a process to quickly and efficiently liquidate a large, complex financial company that is close to failing. I won't bother reading anymore, but you can read it on your own. But again, let me stress, they had this meeting November 2022. Several months later, we saw what happened. We saw banks failing. My point is they knew what type of trouble the banks were in, so they had this meeting to tie up any loose ends to make sure things went as smooth as possible. This is very important, people, so we have to be watching what they say. We may not understand it when we first hear it, but you got to keep it in the back of your big head so when the time comes, you can be like, oh, now it makes sense. So we heard her question. Let's hear their response. All right, let's go.
First of all, I'd like to praise the FDIC for its unrelenting pressures to have more disclosure under the actual public reports. I think they have been very helpful. Second, I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in, they're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So I'd like to take a slightly different view.
Okay, first off, what he said was not that damn funny. It wasn't that funny for her to be just falling over laughing like that. That wasn't even that funny. Actually, it wasn't funny at all. But here's the thing. Did you hear what they said? They said, we don't have the attention span to sit down and learn about this stuff. He say we too busy reading tweets and doing TikTok dances to understand or learn about what's really going on with our money. I mean, they plain out said it. And where's the lie? Where's the lie? This video right here will probably get less than 100 views. I'm not going to even try to figure it out, but I'm going to keep putting this stuff out because somebody will watch it. Somebody will. Maybe my close family and friends. Oh, no, they won't. A couple of people will watch it. But I mean, come on, y'all. This is serious. They just came out and told you people have short attention spans. And the people who need to know, they'll know. The people who won't want to know, they won't know because they're too busy reading tweets. I mean, it's pretty sad. But anyway, what we need to know is a bailout versus a bail-in. That's very important. So let me just explain or read very briefly what a bailout is. A bailout is financial support provided by a government or other financial institution to a struggling bank. That's a bailout. And we saw that back in 2008, when last time the banks crashed. The government is always bailing these large corporations out because they say they're too big to fail. Now, this one right here is the one that people need to be aware of, which is a bail in. A bail in provides relief to a financial institution on the brink of failure by requiring the cancellation of debts owed to creditors and depositors. Creditors and depositors. Creditors and depositors. Creditors and depositors. Depositors. So if you have money in a bank and they want to do a bail in, kiss your money goodbye. That is a bail in. Now, some of you may say, well, I never heard of a bail in. I don't think that'll ever happen. Keep watching. Keep watching. This is from that same meeting. Watch this.
So just, we've touched on a lot of this here, but just quickly, and how do we think about what's the right strategy? There's not a single answer. These are the broad, three approaches that we think about. But we really focus on the middle option here, the use of a bridge bank. We've talked about why a sale to a third-party acquirer would be a significant challenge. A liquidation would be extremely costly. For a bridge bank, one thing that we're looking very, very closely at is that there's a big difference between a bridge in which we can pass all deposits and a bridge in which we can only pass insured deposits. And if there are losses incurred by the depositor class, then that makes it harder to pass the least cost test and to pass all deposits. It also means that the franchise is probably significantly destroyed at that point. And then, importantly, a bridge strategy, that's not an exit. That's only half a strategy. You need an exit to have a full strategy. And so, while we focus on making the bridge itself feasible, we think about some of the ways that we could exit from a bridge. And certainly, being able to more readily break up parts of these institutions by lines of business, regional franchises, just sales of portfolios, and looking at that in advance, that's very helpful, and it could help with a multiple acquirer type exit. We think about, whole bank type exits, maybe over time, if there's time to market out of a bridge, you could have a single acquirer. You could have an IPO type exit. And if there's significant long-term debt, you could contemplate a bail-in type exit for these institutions too, where you're turning the institution over to its creditors. The problem is that, the FDIC is not going to want to be in a bridge for an extended period of time. And these institutions are very large. And so executing any of those options could take a long time. And there's not a built-in exit strategy like there is for GSEBs. And maybe I'll just turn to the last slide here. Just acknowledge, there's, in addition to building up our own operational capabilities to operate a large bridge, these are some of the things that we're doing to enhance large bank resolvability. Obviously we have the IDI resolution planning process. We're strengthening that, starting with a number of submissions that are coming in this year. We've committed with the Federal Reserve to provide guidance to Category 2 and 3 institutions, so some of the largest banks that file Title I resolution plans. And then we've noted the ANPR on long-term debt, and we look forward to seeing the comments on those come in towards the end of the year. I think that's it on this topic.
Did you guys catch how smoothly and subtly he said bail-in? That was amazing. So bail-ins are on the table, and you need to be aware of that. Okay. So while I have your attention, I want to talk about something else that's important. Operation Northwoods. And this is something else that was never discussed in the media, but they had discussions about that, just like they did with this bank meeting. And it says Operation Northwoods was a proposed false flag operation that originated within the U.S. Department of Defense of the U.S. government in 1962. The proposals called for CIA operatives to both stage and commit acts of terrorism against American military and civilian targets, blaming them on the Cuban government and using it to justify a war against Cuba. Let that sink in for a second, people. That is the type of people that we are dealing with. They will create a situation and then have the solution for us. So everything that we see is pre-planned. And one last question for you. Can you imagine if they discussed this in history class? Can you imagine if this was talked about in fifth grade history or high school history? What kind of world will we live in, and how will people react and think? Just Just think about everything that's going on in the world and know that it's all pre-planned, and they have meetings about all of it. Every last bit. Nothing happens on accident, people. Nothing. Okay, so basically their plan is already in motion. Again, that meeting was a year ago. And so here we are. So now what do? We can complain and we can analyze the situation, but we still have to move forward and protect ourselves. So the first thing we need to do is pay attention to what's going on around us and look at these stories that do not make mainstream news. And another thing we need to do is have multiple banks, because one bank could fail, one bank could limit your access to your funds, whatever. But if you have other banks, you have multiple banks, that will help lessen the risk of something bad happening to you. Next, keep cash outside of banks. Have physical dollars somewhere on your possession, either on in your pockets or purse or at home. Have physical cash, because you never know what's going to happen. And I didn't even talk about cyber attacks and power outages and none of that stuff. That's a whole nother topic that we can address at a later date. So you want to have physical cash. Next, you want to have physical gold and silver. That's another topic that I've talked about many times, but there's a good chance that the dollar could collapse or it will continue to lose value. That is where gold and silver will come in, because gold and silver are actual money and have been used as money for thousands of years. And it won't go bankrupt. It won't go to zero like a dollar in fiat currency. Next, expect the unexpected, especially on Fridays, because that's exactly what she said in the meeting. They prefer to have these things happen on Friday so they can do what they need to do on the weekend. And on Monday, they got a brand new system in place. And next, or last but certainly not least, everything that we see is pre-planned. Nothing happens on accident. We got too many think tanks. We got too many computer models. We got too many people who are planning for things to happen. And it's pre-planned so they can maintain control. So that's it in a nutshell, people. I hope you really got something out of this. But at the end of the day, you got to learn how to protect yourself, because the powers that be may not have your best interests at heart. All right, guys. So let me know what you think. Leave me a comment. What do you think about the banking situation? I believe we're just seeing it. It's just starting. I think we're going to see more bank crashes, and there's a lot more drama ahead of us in 2024. But it's up to you to protect yourself, because, again, they do not have your best interest at heart.